Hi everyone, welcome back to my channel. Quick question. If I gave you 1 lakh today, would you rather spend it on your phone or turn it into 2 lakhs without working extra hours? That's exactly what the stock market can do for you if you understand how it works. Hey, wait a second. Before we dive into the video, make sure to hit that subscribe button. That way you will get notified whenever I upload valuable finance content. Alright, let's jump into the video. But here's the problem. In India, most people either think the stock market is gambling or they think you need to be math genius or have inside connections to make money. Truth is, neither is true. Think about it. In the last 10 years, Reliance share price has grown over 300%. TCS, Infosys, HDFC Bank all have created wealth far beyond what a saving account can do. And the best part, you do not need lakhs to start, even 100 can be your first step. In the next few minutes, I will break down exactly what the stock market is, how it works in India, how to buy your first stock, and how you can make passive income from it in the simplest way possible. So, if you have been scared, confused, or just curious, stay tuned because this might change how you think about money forever. Next, what is the stock market and how it works in India? Alright, so what exactly is the mysterious stock market? Imagine you and your friends want to start a chai cafe. The total cost is 10 lakh, but you only have 2 lakh. So you divide the business into 10 equal parts called shares and sell them to friends, families, or even strangers who believe in your idea. In return, they now own a piece of your cafe and can share in its profit. If your cafe becomes the next big thing, the value of those shares goes up. That's exactly how companies like Infosys or Reliance work. Except instead of a chai cafe, we are talking billion rupee businesses. In India, these shares are bought and sold on two main platforms, NSE and BSE. NSE stands for National Stock Exchange and BSE stands for Bombay Stock Exchange. Think of this exchange like massive online marketplaces like Amazon, but instead of shoes or electronics, people are trading piece of companies. And the best part, you do not have to be a businessman to take part. Anyone with a demat account, a little money, and some passions can own a slice of India's biggest companies. Next, NSE, BSE, Sensex, and Nifty, what these actually mean. Now you have probably heard these words on this news. Sensex is up, Nifty is down, but what do they actually mean? Let's start with the NSE, National Stock Exchange, and the BSE, Bombay Stock Exchange. These are the two main shops where you can buy and sell shares in India. BSE is older, started in 1875 and is one of the oldest in Asia. NSE come later in 1992 but is now bigger in trading volume. But here's where Sensex and Nifty comes in. Think of the Sensex as a scoreboard for the BSE. It tracks the performance of the top 30 companies listed there, like Reliance, HDFC Bank, Infosys. If the Sensex goes up, it means on average those companies are doing well. The Nifty 50 does the same for the NSE but with the top 50 companies. These indexes are like thermometers for the economy. If they rise, the market feelings hot. If they fall, things are cooling down. So when you hear Sensex hits a new high, it's like saying the most trusted companies in India just broke their own record. Now let's see types of stocks: blue chip, mid cap, and penny stocks. Which is right for you? Okay, so not all stocks are created equal. Just like in cricket, you have star players, solid middle order batsmen, and risky newcomers. The stock market has its own categories. Blue chip stocks are star players. These are big, established companies like Reliance Industries, TCS, HDFC Bank. They have been around for decades, make steady profits, and are considered safer for long-term investing. They won't usually double overnight, but they also won't collapse at the first sign of trouble. Mid-cap stocks are like the promising middle-order batsman. Companies that are smaller than giant but growing fast. They have more potential to give higher returns but also a bit more risk. Penny stocks, these are the wild cards. Very small companies with share price that can be just a few rupees. They can turn into huge winners or disappear completely. Many beginners get tempted here, but without research, it's easy to get banned. Now let's look into how to buy your first stock in India. So let's get practical. How do you actually buy your first stock in India? Step 1. Open a demat and trading account. A demat account stores your shares digitally and the trading account lets you buy and sell them. Most brokers like Zerodha, Upstock, Angel One, or even banks like ICICI and HDFC can set up this online in a day or two. Step 2. Complete your KYC verification. This is where you upload your PAN card, Aadhaar, bank details, and a selfie for identity verification. Step 3. Add funds to your trading account. You can start small, even 500 or 1000. Step 4. Use your broker app or website to search for a company. For example, let's say Infosys. You will see the current share price, a buy button, and options for how many shares you want. Step 5. Place the order. If it's market order, you will get the shares instantly at the current price. Congratulations, you now own a part of a company. The real skill, not just buying, but knowing why you are buying and when to hold for the long run. Dividend investing, how to earn passive income in the Indian market. Now let's talk about one of the sweetest parts of investing, dividends. A dividend is basically your shares of a company's profits paid directly to you without selling your shares. Think of it like owning a shop, but instead of working there, you still get a cut of the earnings every few months. In India, many big companies like ITC, Hindustan Unilever, Infosys, and Coal India pay regular dividend. For example, ITC has a history of paying out dividends year after year. So if you own 100 shares, you might get a few thousand rupees in your bank account annually just for holding them. The magic happens when you reinvest those dividends into buying more shares. That's called compounding. Over years, it can snowball into serious wealth. But remember, not all companies pay dividend, and just because a company has a high dividend does not always mean it's a good buy. Sometimes a high yield is a sign of trouble. The smart move, look for stable, profit making companies with a strong dividend track record and then let time and compounding do the heavy lifting. Now let's see best practices and common mistakes to avoid. Before you jump in, here are some golden rules that can save you years of regret. Number 1. Invest, don't gamble. Your stock market is for building wealth over years, not for doubling your money in a week. If you treat it like a casino, it will treat your money the same way. Number 2. Do your research. Don't buy a stock just because a friend, a WhatsApp group, or a random YouTuber said so. Look at the company's business, profits, and history. Number 3. Start small. Even 500 or 1000 is fine at the beginning. The goal is to learn without losing sleep. Number 4. Diversify. Don't put all your money into one stock. Spread it across industries like banks, tech, fast moving consumer goods. So if one sector dips, the others balance it out. Common mistakes to avoid: panic selling when prices drop, chasing hot tips, and investing money you might need next month. Remember, patience and discipline are your biggest allies. In the stock market, time in the market beats timing the market. Now let's see motivational clause. The best time to start investing was 10 years ago. The second best time, today. You do not need to be rich, you don't need to be an expert, and you definitely don't need to be wait for the right time. Every successful investor you have heard of, Rakesh Junjwala, Radhakishan Damani, they all started small and learned along the way. The stock market is not just about money, it's about freedom. Freedom to choose how you live, freedom to retire earlier, freedom to stop worrying about every little expense. And that journey can start with your first 100. So here's your action plan. Open the Demat account, pick one solid company you understand, invest a small amount and watch how your perspective on money changes. And hey, if this video made the stock market feel a little less scary, hit that like button so more beginners can see it. Subscribe for more no-nonsense investing guides and drop your questions in the comment. I read every single one. Your future self will thank you for starting today. Let's grow together. Thanks for watching and see you again.